At this precise second, Bitfarms Ltd is trading on the Toronto Stock Exchange at a price of 3.84 CAD, showing a marginal intraday decline of 0.0050 points, or roughly 0.13% to the downside. To the uninitiated observer, glancing at a basic ticker tape on their phone while waiting for a latte, this looks like a day of utter stagnation. A flat line in a market known for cardiac arrest-inducing volatility. But if you look closer, past the surface-level tranquility of that nearly unchanged price, you will find a company in the middle of a violent existential metamorphosis. The expectation for Bitfarms has always been simple. It is a high beta proxy for Bitcoin. When the coin runs, the miner runs. That is the easy narrative that has driven retail flow into this name for years. The reality, however, is far more complex and significantly more dangerous. Bitfarms is no longer just a Bitcoin miner. It is effectively a distressed energy infrastructure developer attempting to perform a high-speed pivot into the cutthroat world of high-performance computing and artificial intelligence, all while fending off the lingering shadow of a hostile takeover from Riot Platforms. What you are seeing today at 3.84 CAD is not stability, it is the calm of a stalemate. The market is currently trying to decide if this company is a strong sell due to its widening earnings misses, like the heavy 8-cent loss per share reported just last week, or if it is a misunderstood deep value play sitting on power assets that are becoming more valuable than the Bitcoin they produce. When you open your brokerage app, whether you're using Robinhood to trade fractional shares or checking your Fidelity Investments dashboard, you're likely seeing a mix of conflicting analyst ratings. Some see the massive drop in revenue expectations as a sign to exit, while others look at the 2026 targets for AI deployment and see a potential multi-bagger. This disconnect creates the tension we are analyzing today. You might hold Tesla stock for its exposure to autonomous driving, or NVIDIA stock because they make the chips, but companies like Bitfarms are the ones building the actual power plants and cooling systems required to run those chips. The expectation is that Bitfarms will struggle with capital expenditures. The contrarian reality could be that their power density capacity, specifically the upgrade to 190 kilowatts per rack at their Washington site, makes them a prime acquisition target for a hyperscaler, not just another miner digging for digital gold. Let's analyze the immediate price action we are seeing today. The stock is hovering at 3.84 CAD, refusing to break significantly lower despite the heavy bearish pressure from the recent Q3 earnings miss. Volume is relatively thin, suggesting that the sellers who wanted out after the earnings report have largely finished their liquidation, and we are now left with a standoff. This is often what happens when individual brokerage accounts and self-investing enthusiasts hit pause to reassess the thesis. On platforms like Interactive Brokers, where more sophisticated traders operate, we are seeing a tightening of the bid-ask spread. This consolidation often precedes a breakout, but the direction depends entirely on whether the market believes CEO Ben Gagnon's promise that the pivot to AI is real and not just a buzzword-filled distraction from declining mining margins. Consider the broader context of online investing. If you were to look at Schwab Intelligent Portfolios or similar robo-advisor strategies, they typically filter out microcap miners due to volatility. But Bitfarms is unique because of its institutional ownership battle. The fact that Riot Platforms holds a massive stake, nearly 20%, puts a floor under the stock price that other miners like CleanSpark or Marathon might not have. Riot can't buy more without board approval due to the recent settlement, but they're not selling either. This creates a scarcity of floating shares that can amplify moves when volume returns. If you're using SoFi Invest or SoFi Active Investing, you might notice that the social sentiment feeds are quiet today. That silence is deafening because it usually means the retail crowd is waiting for a signal, perhaps a rise in Bitcoin above a key resistance level or a press release detailing the financing for the new HPC upgrades. We need to talk about the high-performance computing pivot because this is the single most critical factor for the stock right now. High-performance computing is not just plugging in a different computer, it requires entirely different thermodynamics. Bitcoin miners, ASICs, are rugged. You can run them hot and dirty. AI GPUs, like the ones from NVIDIA that Bitfarms wants to host, are delicate. They need precise humidity control, dust filtration, and massive bandwidth. Bitfarms' announcement that they are converting the Washington site to handle AI workloads by 2026 is a massive gamble. They are essentially saying, we are going to stop printing money, Bitcoin, with this facility to build a rental property for Apple stock or Microsoft AI developers. The market hates the timeline. 2026 feels like a lifetime away in crypto years. That is why the stock was punished recently. Investors want immediate gratification, the kind they get from a Robinhood crypto trade that goes up 10% in an hour. Bitfarms is asking for patience, asking investors to treat their holding like a Fidelity Wealth Management long-term asset rather than a flip. Now I want you to pause for a second and engage with this idea. Comment below how many shares of Bitfarms you currently hold, and more importantly, do you believe they will actually finish the Washington site conversion on time, or will they run out of cash first? I want to see where the sentiment is among actual holders. Let's look deeper into the financials that are weighing on the price at 3.84 CAD. The company reported a net loss of roughly $46 million in the last quarter. In the world of investment help and investing sites, a loss that big usually triggers a sell rating. But you have to strip out the non-cash items. A huge chunk of that loss was depreciation, an accounting figure. The cash burn is the real concern. They're spending heavily to upgrade equipment. If you're managing your own Fidelity IRAs or looking for investment opportunities, you have to ask, is this spending good or bad? Good spending builds assets that generate future cash flow. Bad spending just keeps the lights on. Bitfarms argues that this is asset building. They are upgrading to T21 miners, which are vastly more efficient. In the mining game, efficiency is the only moat. If your electricity cost is higher than the price of Bitcoin, you die. Bitfarms has some of the lowest energy costs in the industry due to their hydropower dominance, particularly in Quebec and Paraguay. This fundamental advantage is often overlooked by the Robinhood app crowd that only chases the green candles. The comparison to Tesla stock is apt here, not because of the product, but because of the capital intensity. Tesla burned cash for years building factories before it became a profit machine. Bitfarms is in that burn phase. The risk, of course, is that they're burning cash in a sector where the underlying commodity, Bitcoin, can drop 50% in a month. This is why Interactive Brokers' stock data often shows high implied volatility on BITF options. Hedging this stock is expensive. If you're using SoFi stocks or SoFi ETFs, you rarely get exposure to this specific kind of idiosyncratic risk. The risk of a company trying to change its entire business model while flying the plane. Let's discuss the Riot factor again, because it cannot be overstated. Riot Platforms tried to buy Bitfarms for around $230 a share back in April or May. Bitfarms rejected it, initiated a poison pill to dilute shares if Riot bought too much, and then eventually settled. This drama effectively put a put option on the stock. Investors know that if the price crashes too low, Riot or another player like Marathon might swoop in and buy the whole company for their power contracts. Power capacity is the new oil. In an AI world, a legally secured connection to 200 megawatts of power is worth billions. Bitfarms controls a massive power pipeline. This is why, even at 3.84 CAD, some value investors see this as a steal. They're not buying the mining, they're buying the plug in the wall. However, there is a bear case that we must respect. The Interactive Brokers platform and other professional analysis tools highlight a deteriorating quick ratio for Bitfarms. Their liquidity is tightening. If Bitcoin stagnates at current levels, Bitfarms might have to issue more shares to fund that 2026 AI vision. Share issuance is the enemy of the shareholder. It dilutes your slice of the pie. We have seen this happen with Robinhood investments in other speculative sectors. The company survives, but the stock price stays flat because there are twice as many shares in circulation. This fear of dilution is the heavy blanket keeping the stock at 3.84 CAD today. Furthermore, the sector momentum is mixed. While Nvidia stock continues to defy gravity, the AI proxy trade for miners has cooled off. Earlier this year, any miner that said AI popped 20%. Now the market is demanding proof. Fidelity mutual funds and Fidelity ETFs that track the crypto sector have been rotating capital into the larger caps like Marathon and CleanSpark, leaving smaller players like